So, if you've got 100,000 rand in your account, and you're new to this, you should not bet. You should not risk any more than 1 to 2% of that in any one trade. So the maximum loss, ladies and gentlemen, that you ever have on any one trade should never be more than 2,000 rand. And that will keep you alive.
Hey trader, welcome back to the David Paul series here at ComLucro. In this third part of his lecture at the Johannesburg Stock Exchange, David dives deep into one of the most crucial yet misunderstood pillars of trading success: position sizing and risk control. Through a simple coin flip experiment, he demonstrates how probability clusters can wipe out traders who risk too much per trade, no matter how good their system seems. His point is powerful. Consistency and survival in the markets depend not on prediction, but on disciplined money management. If you've ever wondered why so many skilled analysts still lose money, this lesson will make it crystal clear. So if you like this kind of video, please like, subscribe, and turn on notifications. And join the ComLucro community to support the channel and keep improving as a trader.
I want you to use your wonderful imagination. Because in this vessel, we have 100 1 rand coins. Yeah? You see them? Right? Now, on every decision, on every trade, there's two decisions. One, is the damn thing going to go up or is the damn thing going to go down? Now, Barry alluded to the concept of going short, which might be new to some of you, but you can take a bet that the market's going to fall. And if it does fall, you're going to make some money. So, that's the first decision. So, the man in the green, heads or tails? Tails. The market's going to fall. The bear in the green. We've got 100 coins. The second decision, ladies and gentlemen, is how much do you want to bet? You can bet 1 coin. You can bet 5 coins. Or in the parlance of the commodity futures market, you can bet the farm, the whole bloody lot. Farmers love betting the farm. Okay. So the man in the green says the market's going to fall. Tails. How many would you like to bet, madam? 1, 5, 20, 75? 20. Okay. So let's trade. What we're doing is we're simulating a trading system that's right 50% of the time, that makes us twice as much when it's right as it loses when it's wrong. I assure you that if you were a day trader in the Forex market, you would sell your granny for that system. Okay? Your granny. Because most intraday systems will risk 30 to make 50. And if the vendor is honest, it's not right that much more than 50% of the time. So, the man in the green, are you feeling lucky, lad? Okay, don't take it too personally now. That's not a great throw, not a great throw. Pound coined is much easier. Sorry, mate. It's going up. You lost. Sorry. No, he bet. He bet was going to go down. So 20 gone, and we've got 80 left. The man in the red, heads or tails? You, sir. You'll never wear that red pullover again. Heads or tails? Pardon? Heads. We've got 80 coins left. The man with a cold head, with a cap on. Remember John Wayne's last movie? He said to the guy coming in, he said, "Is your head cold?" He was still wearing the hat of his hat. We've got 80 coins left. How many would you like to bet? Pardon? 40, he says. Okay. This trade is totally independent of any other trade that you're ever going to take in your life. This is the first of the 10,000 trades that you're going to take between now and death. You said heads, hey man? Let's see if I can get this right. That's an awful throw. Pound is much easier. That's better. Heads is correct. So we get 80. 80 and 80's 160. We're ahead of the game. Now folks, the man in the red was lucky, unfortunately. What's the probability of a bad one? 1/2. Now, what's the probability of 2 bad ones in a row? 1/4, half times 1/2, which is 1/4. Now, in a 50% system, unfortunately, you get 2 bad ones every 4 trades. Ladies and gentlemen, if you were to bet 50% of your coins on any one trade, you go bankrupt every 4. Do you understand that? Gets worse. What's the probability of 3 bad ones in a row in a 50% game? 1/2 times 1/2 times 1/2, which is 1/8. That means throw a few coins when you get home. That means that in 8 throws of the coin, or 8 trades in a 50% system, you have a cluster of 3 bad ones in a row. That means, ladies and gentlemen, that if you were to bet 1/3 of your coins on any one trade, you go bankrupt every 8. Okay? And most people go bankrupt because they bet far too much on any one single trade. Now, the bet size is the difference between your entry point and your stop loss. Right? So if you buy a share at 10 Rand and you've got a stop loss at 8.50, if it falls from 10 to 8.50, that's the bet size. Okay? Am I correct, GT gentlemen? I think I am. So, unfortunately, there's a massive paradox here, because you do the fundamental analysis, you do the technical analysis, and you're sure the damn thing's going to go up, yeah? That's why you're putting the trade on in the first place. So, if you're sure it's going to go up, why not have a big bet? Let's accelerate the process of wealth accumulation. So you decide to trade far, far too big. And then, all of a sudden, you get a run of these bad ones. Now, if you don't believe me, here's what I want you to do tonight. Go to Monte Casino. Who goes to Monte Casino? Anybody? All right. You get to the casino tonight, lads. You go to the roulette wheel. It's a 50% game. Equal number of blacks and reds. And there's a little white ball, which is GT's cut. That's the house edge. Okay. And you look at the scoreboard down at the end, and you're going to see long runs of red and long runs of black. Those clusters are real. And it's this clustering effect that makes playing the game so difficult. Because you get long runs of good trades where you think you're God, and long runs, unfortunately, of bad ones where you feel like something that's under your shoe. Okay. Now, the first objective, ladies and gentlemen, is to live through the clusters arithmetically, that you don't go broke in them. Okay? Because you can quite easily have a cluster of 5 bad trades. Am I correct? Sure. 5 bad trades happen on a 50% system every 32. Alright? So if you were to bet 20% of your loot on any one particular trade, you go bankrupt every 5. And there is a big problem here. So there's a chap called Ralph Vince, and he's written a long series of books called Effective Portfolio Manager for Traders. Thick books. They've got them at Investec, they've got them at ABSA. But not bedtime reading, I assure you. And the gist of all of this is that you should not risk any more than 1 to 2% of your kitty on any one trade. So, if you've got 100,000 rand in your account, and you're new to this, you should not bet. You should not risk any more than 1 to 2% of that in any one trade. So the maximum loss, ladies and gentlemen, that you ever have on any one trade should never be more than 2,000 rand. And that will keep you alive.
What David Paul just explained goes straight to the heart of long-term trading survival. It's not about how often you're right. It's about how much you risk when you're wrong. Most traders fail not because they misread the market, but because they bet too big and don't respect probability clusters. His demonstration with the coin toss shows a simple truth. Even with a system that wins half the time, poor position sizing can wipe you out. That's why professional traders treat capital preservation as their first goal. They think in terms of percentages, not emotions, and never risk more than a small fraction of their account on any single trade. When you manage risk properly, losing streaks become just another part of the process instead of a threat to your trading career. Consistency is born from survival, not prediction. So as you build your own system, remember, trade small, trade smart, and let mathematics, not emotion, guide your decisions. That's how real professionals stay in the game. And that concludes part 3 of David Paul's seminar at the Johannesburg Stock Exchange. In the next part, we'll dive deeper into how he connects psychology, expectancy, and emotional control to create true mastery in trading. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.